Let's get to understand the term underwriting and underwriting accounting. Underwriting is the exchange of a fee for the acceptance of risk. This is a risk transfer from one party to another and is most commonly found in loans, IPOs, insurance, investments. Loan underwriting, insurance underwriting, securities underwriting are terms you would come across in the financial space. Underwriting account is a nominal account and is prepared by the underwriter to ascertain the profit or loss on underwriting. Underwriters assess the degree of risk of insurer's business. Let's look at the types of underwriting. Here we shall restrict our learning to the commonly used ones. First is firm underwriting. In firm underwriting, the underwriters take up the agreed number of shares or debentures even if the issue is oversubscribed. Next comes complete underwriting. In complete underwriting, the whole issue is underwritten either by an individual or institution, agreeing to take the entire risk by each party but to a limited extent. In partial underwriting, only a part of the issue of shares or debentures of a company is underwritten. Next is syndicate underwriting. Here, a few underwriting firms form a syndicate and jointly undertake to underwrite the issue. Next is joint underwriting. In joint underwriting, the issuer company itself appoints more than one underwriter to reduce the burden from a single underwriter. Next is sub-underwriting. We come across a situation where an underwriter, after promising to underwrite an issue, later feels that it is beyond its individual capacity. In such cases, he may appoint a sub-underwriter, more of a support hand, to safeguard himself. In such cases, the sub-underwriter is liable to underwrite only and he has no connection with the company. The relationship between underwriter and sub-underwriter is same as an agent and sub-agent. Let's take an example. ABB enters into a contract with BBC Limited to underwrite its 5,000 shares of Rs 10 each in consideration of 5% commission. He also enters into an agreement with CDC to sub-underwrite 1,000 shares of BBC Limited at a commission of 3%. The public subscribes for 2,000 shares only, and subsequently shares were taken up by ABB, who sold his shares at Rs 9 per share. The shares taken up by CDC were sold at Rs 10 per share. Expenses of underwriting amounts to Rs 600. Prepare underwriting account in the books of ABB. Let's look at the debit side first. Bank account for expenses is Rs 600. Bank account for 3,000 shares taken up is Rs 30,000. Bank account for a commission to sub-underwriter is Rs 300. Now let's look at the credit side. You would have already computed the debit side totaling to 30,900. Coming back to the credit side, bank account for commission is 2,500. Bank account for transfer shares to sub-underwriter is Rs 6,000. We need to derive that amount. Bank account for selling of taken up shares is 21,600. Now we need to ascertain whether it's a profit or loss. So the net loss from underwriting transferred to profit and loss account, the balancing figure is Rs 800.